JBlog, 24th of April 2011. It's been a while since I've done a blog. Unfortunately, my Mac had some technical issues, so I had to resolve that, and here I am again talking about the economy. Nothing really has changed that much from my point of view. I believe that we have gotten more overbought rather than less overbought, and it seems the rest of the um, people are starting to catch up with that knowledge. So here we have the Market Watch headline: U.S. economy in slow lane, and whether stocks are ready to slide. Of course, we're getting to sell in May and go away. It's the end of April, so we're entering the weak part of the year. S&P 500 PE ratio is very high, still at 23.63. Nothing particularly good there. For all I'm concerned, once again, the market is still heavily overbought and should should correct. The ECRI index is starting to show some flattening, and that precedes the general economy by about 6 months, and it has problems making new higher highs, so we'll see where that goes. Outside of that, of course, we have oil being very expensive, gasoline being very expensive, retail starting to hit $4 and over in some of the markets. Average across United States is 384. That is amazingly high. So let's see what else we have. Some news I came across. Of course, the whole thing in my mind, the whole thing that has been driving this quote-unquote recovery is the stimulus. The U.S. government borrowed, whether they like to call it or not, they borrowed trillions of dollars and sent it into the economy. The way GDP works is that GDP is made up of government spending as well as private spending as well as investment and a few other things. What is not part of the GDP formula is government borrowing. So if the government borrows $3 trillion and then spends it in the economy, that ups GDP by 3 trillion, but there is no long-term understanding that that money has to be paid back. So still Federal Reserve members saying that, oh no, we can't withdraw the stimulus because the recovery might be over. Well, there is no recovery. There's never been a recovery. There has been a borrowing and spending, and it's been amazing insanity. That's all there was. PIMCO, largest bond trader and holder trader in the world, starting to go negative on U.S. bonds. And we do know that he seems to have a pretty good nose for things. China inflation is somewhat out of control on a weak currency, says Soros. Soros, of course, is a big supporter of the international money scene. Some claim that he's part of the evil empire. I have found no information on that so far, either yay or nay. But anyways, it wouldn't surprise me if China inflation is somewhat out of control simply because of all the money that we're sending that way. Again, we have another Fed saying that, oh, the exit plan should start with the sale of assets. So again, we're starting to talk exiting QE2 and potentially not adding QE3. And that's really what the market is stuck on right now. Is there going to be a QE3 or is there not going to be a QE3? If there's not going to be a QE3, this thing will tank. Greece is once again promising to cut spending and sell assets, but it won't restructure. So the Greeks are still not getting it. The Germans will continue to have to bail them out. And let's forget about this one. London has now decided no longer to build very large skyscrapers and go to cheaper, lower buildings because it's simply cheaper to buy to build a lower building rather than the ultra high buildings. So once again, the insanity seems to be leaving the market. People are starting to realize that we cannot go the way we're going. Um, Banks are starting to have issues with their incomes. Of course, they are paying huge dividends, and the gains are simply not making up for that. Even though they're basically lending money risk-free to the federal government, first borrowing it from the Federal Reserve for next to nothing, and then lending it to the government at a profit. I mean, wow, what a business to be in. I'd love to be in that business and make billions and trillions of dollars. But even that doesn't seem to be making enough money for them to continue paying their high dividends. So that's interesting stuff. The national Here's a New York Times article that talks about the mood being the lowest level in 2 years. That's again not surprising. Um, the marketing machine has been drumming up this recovery, and jobs just around the corner. And of course, there's no jobs and there's no recovery except on Wall Street, and anybody connected with Wall Street and anybody connected with government employees, mostly federal government employees. So Washington is doing well, New York is doing well, and the rest of the country is not. And people are waking up to that. It's taking them a long time, but sooner or later they do figure this out, that there really is no recovery. Here's another interesting New York Times article I came across. Builders, after the 2 years, are seeing no sign of recovery. Again, all this baloney about, oh, sales are picking up, blah, blah, blah. No, no. There is no sales. Again, there's such an overhang of houses that have not even been foreclosed upon yet, that have been in default for nearly 2 years, and the banks are scared to foreclose on them because they know there's nothing there. They know they can't sell those properties, and if they were to foreclose, then they would actually have to take those bad debts onto their balance sheets, and that would look horribly bad for them. And then, of course, inflation, the I word that nobody wants to talk about. So now we're calling it price creep. Of course, now that third world countries no longer want to work for nothing and they actually want to be paid a little bit, and commodities are going up in price, that is making its way into the consumer sector, along with higher gasoline prices. That cuts into spending, people spending, higher food prices. I mean, there's no inflation as long as you don't drive and you don't eat. Otherwise, you will see inflation. Let's look at some markets here. Well, let's look at oil. Oil, of course, is at a high once again as of Friday, except for this little blip here. We're once again in the $112 for West Texas Intermediate crude. Natural gas is starting to show a little bit of life signs, and so it should, simply because every other commodity is going up. Why shouldn't this one? So, so natural gas is getting more expensive, and of course, air conditioning is coming on this winter. I don't know how it is in your part of the country, but this winter has been absolutely awful up in the Great White North. In fact, I would say it's the first day of spring today, and it's the end of April. Gasoline wholesale is at an all-time new high, so that justifies the highs in the retail side. This thing has just been growing phenomenally. The price of gasoline, of course, having oil as an input, but then gold made it over 1500 this week, and that was a big step. But silver, of course, is the big story. Silver has outpaced gold by quite a bit. If we actually look at the gold silver exchange rate, at the highs it was 69.97 here. That's basically 70 ounces of silver for 1 ounce of gold, and that has dropped to 32. So in relation to gold, silver has actually gone up twice as fast as gold. Everybody focuses on gold, nobody focuses on silver. This is most likely, I imagine, JP Morgan having tried to corner the silver market, and finally not actually the other way around, having sold short more silver than there is in existence from some stories, and trying to buy that silver back now at much higher prices. So silver is once again going in relation to gold. They come out of the earth at 1 to 16. So for every 1 ounce of gold we find about 16 ounces of silver. Silver is at this point actually more precious than gold because silver gets used up, gold does not. Gold just gets stored. Um, Solar cells, for example, are a large user of silver. iPods, any electronics, lots of silver being used, and because it is still so cheap, it's not worth recycling it, so it is just being thrown away. So there's actually a silver shortage compared to gold. Gold in euros has not made a new high, so a lot of this move really isn't so much in the price of gold as it is in the price of the US dollar. Let's go over to the US dollar. The US dollar, of course, falling from a year ago, being at 88.71 down to 74, and creating this doji down here. I'm starting to think that perhaps it is starting to be time to look at the US dollar as an investment again. It will obviously not go to zero because US is the most powerful nation in the world, and your reserve currencies traditionally are that of the most powerful nation in the world, bankruptcy or not. United States still has the largest forces, and that will back it up. So US dollar is starting to once again look like an interesting investment. The VIX, I'm still scratching my head. There's nothing here. There's no fear. This market does not assume that anything could go wrong. This was, of course, the Japanese earthquake here, and the VIX bumped up to 30, but it has dropped right back down again. So everything is fine. Don't worry. Go back to shopping. Buy another iPod. Do whatever. That's what the VIX is telling you. And me personally, I'm not inclined to buy that. Um, but then I have been quite wrong for quite a while. But eventually, gravity does catch up with anything that tries to go too high, too fast. Copper has been dropping, so here's the metal with a PhD in economics. It has been dropping, so that's signaling some weakness in construction, perhaps signaling some weakness in China. Thursday actually was an amazing day in the market, just shot straight up. When you look at it from this kind of picture, but if you do look at it on a SPY, you see it's actually more or less a doji up top. All this action happened pre-market. So there's a gap up here and a gap up there. That's the real story. Not this big white bar. This wasn't a natural trade. Core sectors. I'll finish with core sectors. Core sectors are interesting. Materials have been opened, gapped up 2 days ago, but have not made a new high. If it falls from here, that's almost, well, that is a head and shoulder formation if it validates with the shoulders. Energy again has not yet made a fresh high, even though oil has made a fresh high, at least priced in US dollars. Outside of those two, we have the financials. They look ugly. We've got a lower high, lower high, lower high, and lower low, and this one is not quite sure yet. But if we get some more down motion, then we're definitely in a downtrend. The exponential 10 moving average has moved underneath the exponential 30, so it's definitely a bearish movement here. Of course, there'll be a bounce back as always, but the question is, where's the trend long term? Industrials have not made a higher high, so there's another potential head and shoulder formation. Technology, with all the good news out of Apple and the good news out of Intel and so on, technology has not managed to make a new higher high from this one back here in when was that, February. So again, that is interesting. Consumer staples has been very strong. Consumer staples is not a sector that goes up when when everything is nice, that's a sector that goes up. When everything is not nice, it's a defensive sector. So we might very well be looking at a sector rotation here. Utilities have been up flat. Again, that's usually a defensive sector, but in this particular case, a higher oil price, of course, squeeze utilities margins. Healthcare has been on a run, again, a defensive sector, and then consumer discretionary is still pretty flat except for those two large last days, probably based on Apple partially. Um, but in general, it has been pretty flat. So if we're looking at a sector rotation, then we're entering defensive sectors, and we could be looking for flattening out of the S&P or perhaps an actual downward correction. So we'll see how that goes. That's all I have for today. All the best. Happy Easter, and talk to you hopefully next week. Bye.